There are roughly 74 million Americans collecting Social Security right now, and nearly half of them filed the moment they turned 62, without fully understanding what that one date would cost them for the rest of their lives. Not because they were careless, not because they did not care about their retirement, but because nobody ever sat them down and showed them that the day you file for Social Security is the single most expensive financial decision you will make in your entire retirement, and getting it wrong by even a few years can drain more than $100,000 from money you spent a lifetime earning. This is not a small miscalculation. This is not a rounding error in a retirement plan. This is a permanent, irreversible reduction that follows a person for every single month of the rest of their life. And the reason so many people make it is not because they are careless. It is because nobody sat down with them and showed them what the actual numbers look like. So that is exactly what we are going to do today. Here is the foundation you need before anything else makes sense. Social Security does not pay the same amount regardless of when you claim. The government gives you a window between age 62 and age 70, and the month you choose to file inside that window determines your monthly benefit permanently. File at 62 and you collect 70% of what you were actually owed. File at your full retirement age, which is 67 for anyone born in 1960 or later, and you collect 100%. Wait until 70 and you collect 124%. Every single month between 62 and 70 moves that number up or down in small increments. And whatever number you lock in on the day you file, that is your number for life. And now let us put real dollars on that, because percentages alone do not make people feel the weight of this decision. Say your full retirement age benefit, the amount you earned, is $2,000 a month. If you file at 62, you walk away with $1,400 a month instead. That $600 monthly difference does not sound catastrophic on its own. But $600 a month is $7,200 a year. Over 15 years of retirement, that is $108,000. Over 20 years, it is $144,000. And that calculation does not even account for the cost of living adjustments that Social Security applies every January, which are calculated as a percentage of whatever your base benefit is. A lower base benefit means smaller dollar increases from every single COLA for the rest of your life. The gap between the person who waited and the person who did not keeps quietly widening year after year, long after the initial decision is forgotten. That is the $100,000 mistake. And the cruelest part of it is that it is completely invisible at the moment it happens. On the day you file at 62, you receive a letter telling you what your monthly benefit will be. It looks reasonable. It looks like what you earned. Nobody sends you a second letter saying, here is what you gave up. Now, here is the part that makes this even more painful for married couples. And this is where I want every husband and wife watching this to pay very close attention, because this mistake does not just affect the person who files. It follows both of them. When the higher earner in a marriage files early and locks in a reduced benefit, they have also just reduced the survivor benefit that their spouse will live on if they die first. Social Security survivor benefits work like this. When one spouse passes away, the surviving spouse keeps the larger of the two benefits.
I'm going to show you why your Social Security claiming decision isn't just a personal choice. You're also choosing what your surviving spouse may live on for the rest of their life.
The smaller one disappears entirely. So if a husband spent 40 years working and building up a Social Security benefit, and he files at 62 and locks in 70% of what he earned, and then he passes away at 74 or 76 or 78, his wife does not step up to what he could have received. She steps up to that reduced number, and she may collect that reduced number for 15 or 20 years. The mistake he made at 62 is still following her at 85. This is not a theoretical scenario. The average life expectancy for a 65-year-old woman today is around 86 or 87 years old. A man who retired at 62, filed for Social Security immediately, and passed away at 76, has left his wife with a permanently reduced income for the next decade and more. Nobody explained that to them when they were sitting in that Social Security office at 62, feeling relieved that they had finally made it to the finish line. Now, let us talk about the second version of this mistake, because there are people watching this who already claimed and are also still working, and they may have just discovered something very unpleasant on their last tax return. If you claim Social Security before your full retirement age and you are still earning income from a job, the Social Security Administration applies what is called the earnings test. In 2026, if you earn more than $24,480 a year, they withhold $1 in benefits for every $2 you earn above that line. So a 63-year-old who is collecting Social Security and still working part-time, earning $40,000 a year, is $15,520 over the limit. The SSA withholds $7,760 from their benefits that year. Most people do not know this rule exists until they file their taxes and realize the checks stopped coming or were smaller than expected. The money is not permanently gone. The SSA recalculates and credits it back when you reach full retirement age, but your monthly benefit goes up by a smaller amount than most people expect, and the short-term cash flow hit is real and jarring for someone on a fixed income.
Security, most people think one of two things. Hey, maybe I should collect early. I don't know how long I'm going to live. I paid into this thing for a long time. I'm just going to start collecting. Maybe if I start collecting as early as 62, I could invest and do better and actually grow my money more than if Social Security had my money.
This is why financial planners will almost always tell you that if you are still working and earning meaningful income, claiming early is almost never the right call. You are collecting a reduced benefit and then losing part of even that reduced amount back to the earnings test. You are paying a penalty on a penalty. Now let us address the thing that is on everyone's mind, because I know what you are thinking. You are thinking that you might not live long enough to make waiting worthwhile. And that is a completely fair concern. If you file at 62 and live to 75, the person who filed early likely came out ahead in total lifetime dollars received. That is true, and nobody should pretend otherwise. But here is the number that should sit with you. A healthy 62-year-old today has an average life expectancy that extends well into the mid to late 80s. The break-even point between filing at 62 versus waiting until 70, the age where the person who waited has collected more total lifetime dollars than the person who filed early, lands somewhere around 80 to 81 years old. If you live to 85, the difference in total lifetime income between claiming at 62 and claiming at 70 on a $2,000 full benefit is over $130,000. If you live to 90, it crosses $200,000. The people most likely to live into their late 80s are the people who spent their whole careers in office jobs and professional work with good healthcare, which describes a significant portion of the people watching this video right now. And they are the same people who filed at 62 because they were afraid of the uncertainty, because they did not trust that Social Security would still be there if they waited, or because someone told them to get their money while they could. That fear is not irrational. The Social Security Trust Fund is facing real pressure, and the 2026 trustees report now projects that the retirement fund could face cuts as early as 2032 without congressional action. That is a legitimate concern, but here is what most people do not know about that scenario. Even in a worst-case trust fund depletion situation, Social Security does not stop paying. It continues collecting payroll taxes and can still pay roughly 78% of scheduled benefits. A reduced version of a larger benefit because you waited is still almost always more than a reduced version of an already reduced benefit because you filed at 62. Fear is not a strategy. And for the people who spent 35 or 40 years paying into this program through every recession and every job change, and every year when the overtime barely covered the bills, making this decision in a panic rather than with a clear understanding of the numbers is the single most expensive mistake in retirement. You earned this benefit, every dollar of it. You paid in when you were 24 and broke and barely making rent. You paid in at 45 when the kids needed new shoes and the furnace went out in February. You paid in for decades on the promise that this money would be waiting for you. The least this system owes you is a straight answer about what filing at 62 actually costs. Now you have it.